Welcome. Today's deep dive is brought to you by Skip Benton with Coldwell Bankers Select Real Estate. If you are looking to buy a home in Northern Nevada, then contact Skip.
All right, time to jump into some really interesting data about mortgage forbearance. We've got a new article here from Mortgage Point. It came out just the other day, December 30th, 2024.
Oh, wow. Very recent.
Yeah, hot off the presses. And
Hmm?
it's called Mortgage Forbearance Rate Rises for Sixth Consecutive Month. So,
Yeah.
I see a headline like that and my brain starts going like, okay, what's going on here? Forbearance rates are climbing.
Yeah.
And that could signal a lot about where the housing market's going or even the economy as a whole.
Yeah, I think what's interesting here is we think about, economic indicators,
Mm-hmm.
and a lot of times they can feel like abstract numbers,
Right.
but what they represent are real people,
Mm.
grappling with real challenges.
Yeah.
Forbearance is a perfect example of that.
Yeah.
It's a lifeline for homeowners in distress.
Yeah.
But the rising rates suggest that more and more people are needing that lifeline.
Yeah, it's like that canary in a coal mine.
Yes.
If more people are struggling to keep up with their mortgages, what does that tell us about the bigger picture?
Yeah, and this Mortgage Point article gives us some clues.
Okay.
It points out that the overall forbearance rate ticked up again in November,
Okay.
reaching 0.5%.
Okay.
Now, that might not sound like a lot,
Right.
but it's the sixth month in a row we've seen an increase.
So it's a trend, not just like a one-off thing.
Exactly. It's a trend,
Yeah.
not a blip.
I know you're great with financial jargon, but for those of us who aren't,
Sure.
can you just give us a refresher? What is a basis point? Because the article keeps mentioning these small increases in basis points.
Right.
And I just want to make sure everyone listening understands what that really means.
Of course. So a basis point is like this tiny but mighty unit of measurement.
Okay.
In the financial world,
Yeah.
it's 0.1%.
Okay.
So when we talk about a 3 basis point increase,
Right.
we're talking about a 0.03% rise. So it might seem small, but these tiny increments can actually signal pretty significant shifts,
Yeah.
especially when we see them happening consistently over time.
Okay. So even small increases in basis points, especially over multiple months, can be a sign that something bigger is brewing.
Exactly.
And this article breaks down these increases by different types of loans,
Yeah.
which I found really interesting. They talk about Fannie Mae and Ginnie Mae portfolio loans and PLS, which stands for private label securities.
Right.
Can you just walk us through what those different loan types are
Totally.
and why they matter in this context?
Absolutely. Think of these different loan types as like different flavors of ice cream,
Okay.
each with its own kind of unique ingredients and appeal.
Okay.
Fannie Mae and Freddie Mac are like the classic vanilla and chocolate.
Okay.
They're government-sponsored enterprises that buy mortgages from lenders, and that helps provide stability to the market.
Okay.
Ginnie Mae, on the other hand, is a bit more specialized. It guarantees loans made to veterans,
Mm-hmm.
low-income borrowers, and others who might not qualify for conventional financing.
Okay. I'm starting to see how these different flavors might be impacted differently
Exactly.
by these economic shifts.
Precisely. And then you have portfolio loans and PLS, which are kind of like the gourmet ice cream flavors.
Okay.
They're held by private investors
Mhm.
and tend to have more flexible terms, but also potentially higher risks.
Okay.
Now, what's fascinating is over the past 6 months, Ginnie Mae loans saw the biggest jump in forbearance, a whopping 72 basis points,
Wow.
compared to a mere 11 basis points for Fannie Mae and Freddie Mac loans,
Okay.
as well as portfolio and PLS loans.
Wow. That's a big difference.
Huge difference.
It makes you wonder if certain flavors, like Ginnie Mae, are melting faster than others
That's a great analogy.
under this, economic pressure.
And it raises an important question. Why are Ginnie Mae loans seeing such a disproportionate increase in forbearance?
Yeah.
Well, if we look at the types of borrowers who typically use Ginnie Mae loans, often those with lower credit scores or smaller down payments,
Okay.
it kind of paints a picture of potential vulnerability.
Yeah.
These borrowers might be more susceptible to job losses, rising costs of living,
Right.
or unexpected financial shocks.
So it's like certain segments of the population might be feeling the squeeze more acutely than
Exactly.
others.
Yeah.
It's almost like some folks are getting hit harder by the same storm because their houses weren't built quite as strong.
Exactly. And that's where understanding the nuances of these loan types and the demographics of the borrowers who use them becomes really crucial. It's not just about dry statistics.
Yeah.
It's about the real life impact on people's ability to keep a roof over their heads.
And this Mortgage Point article also dives into the reasons people are requesting forbearance, which I thought was really illuminating.
Yeah.
It seems like things have shifted quite a bit since the early days of the pandemic, wouldn't you say?
Absolutely. Back in 2020 and 2021,
Yeah.
the pandemic was the dominant force driving people into forbearance. It was like a
Yeah.
tidal wave that
Right.
swept across the economy,
Yeah.
leaving millions financially stranded. But the landscape has changed dramatically since then.
Thankfully, COVID is not the main culprit anymore.
Yeah.
But what's taking its place?
Well, according to the Mortgage Bankers Association survey,
Okay.
less than 2.8% of borrowers are still in forbearance due to COVID-19.
Wow.
The primary reasons now are much more diverse.
Okay.
The survey reveals that 51.3% of borrowers are in forbearance due to temporary hardships. Things like job loss, death in the family, divorce, or disability.
Right.
These are life events that can throw anyone's finances off track, regardless of their income level or credit score.
Sure.
And another 46% are dealing with the aftermath of natural disasters.
Wow. So it's almost like we've moved from one massive storm to a series of smaller but still significant storms.
Right.
Hitting different regions, different demographics. So you might be thinking, okay, what does this shift in forbearance reasons tell us about the financial health of the average homeowner?
That's the million-dollar question, isn't it?
Right.
And the answer might not be as straightforward as we'd like. On the one hand,
Okay.
the fact that fewer people are in forbearance due to COVID is certainly a positive sign. It suggests that the economy has recovered to some extent, and people are generally more financially secure than they were a few years ago.
But on the other hand, this rise in forbearance due to things like job loss and natural disasters paints a more complex picture, doesn't it?
It does.
It suggests that while the pandemic's immediate impact might be fading,
Right.
its economic ripple effects are still being felt.
Exactly.
And these new challenges are emerging.
And that's where understanding the stages of forbearance
Okay.
becomes really important. It's not a one-size-fits-all solution.
Right.
There are different phases borrowers typically go through, each with its own set of implications.
Okay, walk us through those stages. What happens when someone enters forbearance?
Think of it like a journey with several stops along the way.
Okay.
First, there's the initial forbearance plan, which provides immediate relief like a temporary pause or reduction in mortgage payments.
Okay.
Then, if the borrower needs more time to regain their financial footing,
Yeah.
there's the extension phase, which offers an extended period of reduced or suspended payments.
Got it.
And finally, there's the re-entry phase,
Okay.
where the borrower transitions back to making regular payments, hopefully in a more sustainable way.
So it's like a path back to financial stability,
Exactly.
but with different options depending on the individual circumstances.
Exactly.
Now, the article highlights a pretty striking statistic about these stages. It says that a whopping 71.4% of loans in forbearance are currently in that initial stage.
Yeah.
What do you make of that?
That's a significant number, and it suggests a few things.
Okay.
First, it could indicate a recent influx of borrowers seeking assistance, potentially linked to those economic factors we've been discussing, like job losses, inflation, the lingering effects of natural disasters. It's like a new wave of folks needing that temporary lifeline.
It's almost like we're seeing this ripple effect, where the initial shock of the pandemic has subsided, but the waves are still reaching different shores at different times.
Precisely.
Yeah.
And this brings up another crucial question. What happens to these loans as they progress through the stages of forbearance?
Right.
Will they move smoothly towards successful repayment, or are we looking at a potential increase in delinquencies and foreclosures down the line?
It's a little bit of a cliffhanger, isn't it?
It is a bit of a cliffhanger.
Like, are we going to see a happy ending for most of these borrowers?
Right.
Or are we headed for a more dramatic turn of events? I guess we'll have to keep digging into this data to find out.
We'll have to see.
Yeah.
I mean, think of it this way. Forbearance itself isn't necessarily a bad thing. It's designed to be a safety net. A way to help people weather financial storms. The real question is what happens after the storm passes. Do people bounce back, or do they get swept away?
That's a great point. Forbearance buys people time, but it doesn't solve the underlying problems.
Right.
And to really understand what happens next, I think we need to look at how effective those loan workouts are that the article talks about.
Yeah.
They sound like a toolbox full of options to help borrowers avoid foreclosure.
Right.
Can you unpack those a little bit for us?
You got it. Think of loan workouts as a sort of financial first aid kit.
Okay.
So when someone's injured, you don't just leave them bleeding.
Right.
You try to stop the bleeding,
Yeah.
help them heal.
Yeah.
Loan workouts are designed to do the same thing for struggling homeowners.
Okay.
They offer a range of strategies to get people back on their feet financially.
So what kind of tools are we talking about here? What's in this financial first aid kit?
Well, one common tool is a repayment plan,
Okay.
which basically allows the borrower to gradually catch up on missed payments over a set period of time. It's like spreading out the pain, so to speak,
Yeah.
making those payments more manageable.
Right, like taking smaller bites out of a big financial sandwich.
Exactly.
Yeah.
Another tool is a deferral, which allows a borrower to postpone payments for a certain period, kind of like hitting the pause button on their mortgage.
Okay.
This can be helpful for people facing temporary setbacks like a job loss or a medical emergency, giving them time to get back on their feet without falling behind.
So it's like a temporary timeout
Exactly.
from those monthly payments.
A temporary timeout. And then there are loan modifications,
Okay.
which involve actually changing the terms of the mortgage itself.
Okay.
This could mean lowering the interest rate, extending the loan term, or even reducing the principal balance.
Wow.
It's like getting a financial makeover for your mortgage,
Okay.
making it fit your current circumstances better.
So it sounds like there are a lot of options to help people stay in their homes,
There are.
which is great.
Yeah.
But the article also points out something a little concerning about these loan workouts. It says that the percentage of completed workouts that are current, meaning people are successfully making those new payments, has actually decreased. In November, it was down to 66.47%, which is a pretty significant drop from a year ago. What's going on there?
Yeah, that's the question that really jumped out at me, too. It's
Yeah.
like we're seeing some cracks in the foundation of these workout strategies.
Okay.
And there are a few potential reasons why these cracks might be forming.
Okay, let's get into those reasons, because this is where it starts to feel a little bit like a detective story.
I love it.
You know, we're following these clues, trying to figure out what's really happening behind the scenes.
I love that analogy.
Yeah.
And one clue might lie in the types of hardships people are facing now.
Okay.
You know, it could be that the financial blows hitting borrowers today are more severe, making it harder to recover, even with the help of workouts.
Yeah.
For example, if someone loses their job in a shrinking industry,
Right.
it might take them a lot longer to find new employment,
Right.
making it more challenging to catch up on those missed payments.
Right. It's one thing to sprain your ankle. It's another thing to break your leg.
Exactly.
Some financial injuries just take a lot longer to heal.
Exactly. And another clue might be those rising interest rates we keep hearing about. Even if a loan workout helps lower someone's monthly payment initially,
Right.
rising interest rates can quickly eat away at those savings,
Yeah.
making it harder to stay afloat in the long run.
It's like running on a treadmill that keeps getting faster.
Yes.
You might be putting in the effort, but it's hard to keep up.
That's a perfect way to put it.
Yeah.
And then there's the broader economic context to consider.
Right.
Inflation is still a factor,
Yeah.
eroding people's purchasing power
Yeah.
and making it harder to stretch those paychecks to cover everything.
Right.
And even though unemployment is relatively low, there's still a lot of uncertainty in the job market.
Yeah, for sure. So you might be thinking, okay, so what does this all mean for the housing market as a whole? Because it's one thing to talk about individual borrowers struggling. But what happens if those struggles start impacting the bigger picture?
Well, if workouts become less effective in preventing foreclosures,
Right.
we could see an uptick in distressed properties hitting the market.
Okay.
And, when that happens, it can create a chain reaction, potentially putting downward pressure on home values and overall market stability.
Yeah.
Remember, the housing market is like a giant ecosystem.
Mm-hmm.
What impacts one part of it can ripple through the entire system.
And then there are those interesting geographic trends that the article highlighted.
Yes.
It breaks down the states with the highest and lowest shares of current loans, which gives us another layer to this whole detective story.
Absolutely. And this data represents a huge chunk of the first mortgage servicing market,
Okay.
about 62%.
Wow.
And it shows that regional economic conditions play a significant role in how homeowners are faring. The states with the highest percentage of current loans, meaning people are generally keeping up with their payments, are Washington, Idaho, Alaska, Oregon, and Colorado.
Okay, so we've got the Pacific Northwest and the Rocky Mountain states
Exactly.
leading the pack in terms of loan performance. What about the other end of the spectrum?
Well, the states with the lowest percentages of current loans are Louisiana, Mississippi, Indiana, West Virginia, and Alabama.
Okay.
This suggests that homeowners in these states might be facing greater challenges,
Yeah.
potentially due to factors like lower wages, higher unemployment rates, or slower economic growth.
It's almost like we're seeing a tale of two housing markets,
Exactly.
with different regions experiencing these economic wins differently. And this brings us to an important question for you, dear listener.
Yes.
What are the economic conditions like in your state?
Right.
Are you seeing job growth or job losses? Are housing prices still soaring, or are they starting to cool down?
Right.
These local factors can have a huge impact on how the broader trends we're discussing play out in your own backyard.
Exactly. It's all interconnected.
Yeah.
And that's why it's so important to not just rely on national headlines, but to really understand what's happening in your own community, in your own neighborhood.
So we've got this fascinating data about forbearance trends, loan workouts, geographic variations. But I have to admit, I'm still trying to wrap my head around what it all means for the future of the housing market.
Yeah.
It's like we've gathered all these puzzle pieces, but we haven't quite put them together yet.
I hear you. It's complex. But if we step back and look at the big picture, I think a few key takeaways emerge.
Okay.
First, we're seeing a shift in the reasons driving people into forbearance, moving away from the pandemic and toward more diverse set of challenges like job losses, natural disasters, and the lingering effects of inflation.
Yeah.
This suggests that while the economy has recovered to some extent, certain segments of the population are still vulnerable.
Right. And it's almost like this article is hinting at this growing sense of economic inequality,
It is.
where some people are weathering the storms better than others.
Exactly.
Yeah.
And second, we're seeing some potential cracks in the effectiveness of loan workouts,
Right.
which could have implications for the long-term health of the housing market.
Yeah.
If workouts become less successful in preventing foreclosures, we could see an increase in distressed properties,
Yeah.
potentially putting downward pressure on home values and creating a ripple effect throughout the market.
So there's a bit of a question mark hanging over the future.
There is.
It's like, will these workout tools be strong enough to keep the housing market stable,
Right,
or will they start to crumble under pressure?
right. And third, we're seeing how regional economic factors play a significant role in how homeowners are faring.
Yeah.
Some areas are thriving while others are struggling.
Right.
This highlights the importance of understanding the local context when analyzing these broader trends.
So it's like this giant economic tapestry.
It is.
Woven together with these different threads of strength and vulnerability.
Yeah,
And the pattern is always changing depending on where you look and when you look.
exactly. And that's why it's so crucial to stay informed, to keep learning, and to keep asking questions.
Because knowledge is power, especially when it comes to navigating the ever-evolving world of real estate and finance. It's funny how we started this deep dive thinking about all these, dry statistics, but
Right.
we've uncovered so much more. We've talked about economic ripple effects and financial first aid kits and
Yeah.
even canaries in coal mines.
I love it.
It's amazing how one single data point, like that rising forbearance rate, can lead us down so many fascinating paths.
It's a reminder that numbers don't tell the whole story. Behind every statistic, there are real people.
Right.
And real lives facing real challenges. And, that's what makes this topic so compelling. It's not just about abstract economic forces. It's about the impact those forces have on individuals and communities.
Absolutely. And speaking of impact, I'd love to get your take on something that's been kind of swirling around in my mind as we've been talking. The article doesn't explicitly mention this, but it sparked a thought for me. Requesting forbearance isn't just a financial decision, is it? It's an emotional one, too.
It is.
Imagine the stress and anxiety of facing financial hardship,
Yeah.
the feeling of vulnerability, the potential shame or stigma associated with asking for help.
That's such an insightful observation.
Yep.
You're absolutely right.
Yeah.
Even though forbearance is designed to be a safety net,
Yeah.
a positive resource,
Mm-hmm.
there might be these psychological barriers that prevent people from seeking assistance when they need it most.
It's like that age-old dilemma, pride versus practicality.
Yeah.
Some people might be hesitant to ask for help even when they're struggling
Yeah,
because they don't want to appear weak or admit that they're having financial trouble.
exactly. And this raises a whole set of questions that we need to consider
Yeah.
as we think about the future of the housing market and the
Yeah.
well-being of homeowners. How can we create a more supportive and empathetic environment for borrowers facing financial challenges? How can we reduce the stigma associated with seeking help?
Those are such important questions because at the end of the day, we're not just talking about numbers.
Right.
We're talking about people's lives,
Yeah.
their homes, their dreams.
Exactly.
And we need to find ways to support those dreams even when they're facing headwinds.
Couldn't agree more. And that's why it's so important to have these conversations, to bring these issues to light and to explore, potential solutions that address both the financial and the emotional well-being of individuals and communities.
Absolutely. So as we wrap up this deep dive into mortgage forbearance trends,
Yeah,
I think it's safe to say we've uncovered more questions than answers.
we always do.
But that's the beauty of a deep dive, isn't it?
It is.
It's about sparking curiosity,
Mm-hmm.
challenging assumptions, and prompting us to think more deeply about this complex world around us.
I agree. And we want to hear from you, dear listener. What are your thoughts on all of this? What stands out to you from this exploration of mortgage forbearance? What questions are swirling around in your mind?
Yeah.
Share your insights, your concerns, your predictions.
Mm-hmm.
The more perspectives we gather, the richer our understanding becomes.
Because ultimately, this is a conversation, not a lecture.
Exactly.
We're all learning together,
Right.
exploring these complexities of the housing market and its impact on our lives.
And that brings us to our final thought-provoking question.
Okay.
For you to ponder, based on what we've learned today, what does this data make you wonder about the future of the housing market and the potential impact on individual homeowners?
Are we headed for a soft landing, a bumpy ride, or something else entirely? Will those forbearance trends reverse as the economy stabilizes, or are they a harbinger of deeper challenges to come? How will rising interest rates and inflation continue to shape affordability and access to homeownership? And what role will government policies and programs play in mitigating these challenges and supporting struggling homeowners?
Those are great questions. These are just a few of the many questions that are swirling around in my mind. And we encourage you, dear listener, to continue exploring this topic, to dig deeper into the data, to challenge assumptions, and to form your own conclusions.
Share your insights with your friends, family, and colleagues.
Yes.
The more we talk about these issues, the better equipped we'll be to navigate these complexities of the housing market and create a more equitable and resilient future for all.
Thanks for joining us on this deep dive into mortgage forbearance trends. Until next time, keep those brains buzzing and those curiosity fires burning.
And remember, knowledge is power, especially when it comes to navigating the ever-changing world of real estate and finance.
And a big thanks to Skip Benton at Coldwell Banker Select Real Estate for bringing us today's deep dive. If you're thinking about buying a home in Northern Nevada, give Skip a call.